Okay, so let me start with the context for the iron ore price decline. Fundamentally, it was about supply outpacing demand. If you look back in 2011, iron ore prices reached their historical highs of almost $180 a ton. That was driven by a very strong demand from China over the preceding 5 to 10 years, and fundamentally China's lack of domestic iron ore sources to feed that demand. The supply-demand tightness and the very high cost of low-quality marginal Chinese ore is what led to the price peak. From around mid-2011 on, significant new supply of ore from the more traditional supply regions such as Australia finally came on, and that incremental supply effectively started to outpace the demand growth. Over the last 2 years especially, significant volumes of low-cost supply have displaced high-cost sources from China and elsewhere. And so prices have fallen to the level we see today of around $50 a ton. Now it's important to point out that other deflationary factors also added to the price decline. In parallel to the oversupply, we saw weaker currencies in the major iron ore exporting regions such as Australia and Brazil, lower oil prices, and on the back of that, much lower freight rates. In addition, with the prices falling, the miners focused much more than they had in the past on their internal efficiencies and squeezed out often quite significant costs from their operations. So where are we today? Well, further supply is still to come on, but the pipeline is running out. Many projects that were conceived in earlier times have been killed, and nobody is planning any new major expansions in this price environment. Offsetting the potential for some further possible price decline from that new supply, we do expect oil and freight rates to recover, and if not some appreciation of the Australian and Brazilian currencies, then no further depreciation over the medium term is expected. So while the lower iron ore price environment looks here to stay for the medium term, we believe we're at the bottom and we don't expect iron ore prices to move much lower. Let me turn to steel prices now. Raw materials like iron ore are a major part of steel costs, so it's not surprisingly that the lower steel prices over the last 2 years have largely been due to the lower raw material prices. Steel spreads, the difference between steel prices and raw material costs, have been relatively unaffected during this price decline. The big exception to this came in the second half of last year, when steel spreads in China fell as much as $50 to $60 below normal. The Chinese steel industry was losing around $2 billion every month. And since Chinese domestic prices very much influenced the export price, this domestic problem was quickly exported abroad. It damaged prices and profitability of the steel industry around the world. You have to remember, China exports more than 100 million tons of steel annually, so they have a major influence on the international price. At the time of our third quarter results last November, we said we felt the domestic and export prices of Chinese steel could not continue at those levels. We believed that the level of losses Chinese steelmakers were incurring was simply unsustainable. And we have indeed been proved right. The Chinese domestic and export steel spreads have recovered to close to their historical norms. I would say the Chinese industry today is probably still losing maybe $10 to $20 a ton, but it's certainly closer to break even. The key question now is, how sustainable is this? Well, steel is one of a number of industries that the Chinese government has highlighted in its latest 5-year plan, targeting a reduction in capacity in order to make the national steel industry sustainable, to tackle environmental issues, and to ensure China doesn't effectively export what are its natural resources. The recently announced government policy to cut 100 to 150 million tons over 5 years is a step in the right direction to reducing overcapacity of steel in an industry incurring unsustainably high losses. However, risks remain that the targeted reduction won't be enough to ensure sufficiently high utilization rates required for industry sustainability. The other risk is that the pace will be too slow. So the central government needs to ensure that the right systems are in place with the authority to enforce them. That said, China has a history of delivering on its intentions when it comes to its 5-year plans. We all understand the restructuring will clearly take time. So while we remain cautious as further details and ultimately the delivery of the 5-year plan emerges, we do take comfort from the fact that politically the intent seems very serious and is driven from the very top. So the combination of these factors, along with the improvement in spreads that we have seen since the fourth quarter, but especially since January, when there was a lot of nervousness in the commodity and equity markets, provides us with the confidence that we are past the bottom in steel pricing terms. In fact, what has happened so far with steel and iron ore prices in 2016 has been very much in line with our internal projections, and we expect to see gradual improvement throughout the course of this year.